Philip and myself will do a country report in Austria, and any country report probably is supposed to report on the things which are actually happening in the country. And so we have concentrated on those areas where there have been developments in Austria, where we actually have something to report, and where we do not have to invent. This basically means that we will look at the issue of sustainable governance and engagement, for instance. Then we will look at the issue of sustainable fund management. We will probably not look at our fund governance, but we will not look as much, or not at all actually, on product governance. So we do have variety in the issues which are going to be presented today. Let me start by making reference to some facts. What are the facts? The first fact is that the Austrian market is pretty small. Unfortunately, I haven't got my glasses, so I can't read the numbers, but it is approximately, what is it? 11.4 billion. 114, it's not that bad, thank you. 114 billion euro. So that means we do have a small market, which means, at a first glance, that any sustainable finance initiative will not have a huge effect if it is as far as Austria is concerned. Secondly, the precise numbers change, but probably some 50% is free float. The other 50% is core shareholders. And of course, any sustainable finance initiative looking at investment funds and institutional investors cannot address these 50%. So this also shows that the impact is quite limited. And of course, one would have to go one step further and ask, who are the other 50%? Are they impacted indirectly? Probably not by Austrian regulation of sustainable finance, but by foreign regulation. Of course, I do not know, but I do know that quite a number of these shareholders are family offices, which basically are not covered by these issues, but as I say, further analysis would be necessary. So first, quite some limited effect. Now, if I remember the second slide correctly, this looks at the composition of the institutional investors, of those 50%, or rather, it looks at the composition of the 50% which are not in concentrated ownership. And if you look at that, you also see that the number of Austrian institutional investors is quite limited. Investment funds are, I think, 9 or 10% of the 50%. So Austrian investment funds are 5% of the total investment. So any regulation which addresses Austrian investment funds will not be hugely effective as far as sustainability is concerned. You also see that a lot of these institutional investors are from the US and UK. Probably, I don't know how this is precisely counted, but Philipp Fiedler rightly said to me this week that probably it's also lots of Irish, so that these US and UK investment funds are in reality incorporated in Ireland, which happens quite regularly in Luxembourg. So this probably looks at the, so BlackRock I think is there seen as a US fund, while technically it would be an Irish fund. Anyway, what I want to say is that the regulation of sustainable finance for the foreign investors is much more important in its effects than any autochthonous regulation we might have or we do have in Austria for the Austrian investors. So that's the second takeaway I would like to mention. And what was the third one? Yeah, the third one is if you look at the investment funds, what are they? What do they? And you will see that most they are quite equally with growth and value investors, and there are some index trackers, but not a huge number of index trackers. So still the majority of the Austrian funds are actively managed. However, what one does see is that turnover is quite low. So not just, I mean, that index trackers hold the shares for a long time should be no surprise, because that's, as long as the share is in the index, they have them. But also the active funds tend to have comparatively low turnover. So that, from the sustainability issue, is probably a piece of good news, because of course it is easier to have active engagement by institutional investors if those institutional investors do not divest from their shares easily. So those are the first three structural conclusions. The fourth one will be presented by Philip, which also gives me the chance to get my glasses. Philip, please.
Dear professors, dear colleagues, let me just say I'm very, very happy to be a part of this conference and also to be part of this presentation together with Professor Martin Winner. And now, so my first slide will add some facts to the facts Professor Winner had already mentioned. So special with regards to investment funds, so facts regarding the investment fund industry. So I need those. Oh yes, perfect. So, and the thing is, which I think fits in the picture which has been drawn now, the Austrian fund industry is also very small. Like, there is no a report which counts all the management or portfolio management companies and the available mutual funds, but based on an evaluation by the Financial Market Authority in Austria, there are about 14 management companies who distribute sustainable funds. There are about 50, so this might be not an exact number, but approximately there are around 50 mutual funds, which is, as we have already seen, compared to Denmark, for example, it's not a very large industry. And what I've also have seen, or what I could also see, was that almost all of those funds are regulated under the UCITS regime. So there are almost none funds which are alternative investment funds. So they are all regulated by the UCITS directive. And investment policy is like, so the investment policy by these mutual funds or by these management companies, there are all kinds of sustainability criteria. As you can see on the slide, there is no investment in military and armament industry, or in the genetic engineering industry sector, or nuclear power. So there are just a few sustainability criteria. Either they can be seen in the prospect, or the sustainability criteria sometimes are also delegated to an external company, which is also common for Austrian funds. And yeah, they call it a sustainability filter, whatever that means. But yeah, so the fact that almost all funds are regulated under the UCITS regime might also indicate that the sustainable funds are targeted to retail investors, but not merely institutional investors. So there is a broad range of possible investor types. This is also what you can see by the facts given the mutual fund industry in Austria.
So let me continue by saying a couple of things about sustainable ownership, that is shareholder governance, and let me start by talking about the engagement policy, which is of course an important issue which has been introduced by the Shareholder Rights Directive 2, as we all know. The transposition in Austria has been as narrow as possible. So it's not a broad transposition. it is the absolute minimum. And that leads to an important restriction. It is only applicable to Austrian companies, so it's listed companies with a seat in Austria. And it is only applicable to institutional investors and asset managers with Austria as the country of origin. And that's what the directive mandates, but it is quite clear that from the Austrian viewpoint, that does not cover really a lot of what is happening on the market. And if we assume that other member states have transposed the directive in the same way, and I think that Germany has done that, then this would of course mean that there are considerable loopholes in the entire approach. Because then the Irish fund, or the German fund, I don't know what about Ireland, but you will probably tell us, but the German fund, which is invested in Austrian companies, would not be bound by the engagement policy according to Shareholder Rights Directive 2. This, of course, and we will see that in a second, does not mean that they will not follow some type of engagement policy. I was not talking about facts, but talking about legal obligations. Second, this is a purely comply or explain approach. It is not mandatory to have an engagement policy, at least in theory. In practice, of course it is. You cannot just today explain why you don't have one. And there's the engagement report. Now what we've done, we've looked at one of the institutional shareholders, namely Erste Asset Management, which is the biggest one in Austria, with considerable assets under management. And we immediately see that their Erste Asset Management's engagement policy is much broader than the thing mandated by the Shareholder Rights Directive, because of course it covers all the holdings of Erste Asset, irrespective of whether that holding is in an Austrian company or in a company from abroad. And it's actually the first time I've looked at these documents after Shareholder Rights Directive 2 has been implemented. So I was quite surprised how extensive the disclosure is in that respect. I'm not saying it's perfect, but it's much more extensive than I actually expected it to be when I first looked at it. Of course, it's a marketing material at the end of the day. One shouldn't forget that these stewardship policies, that's marketing. Actually, the stewardship policy does say that on the last page. This is a marketing document, which I found quite funny for something for which there is, at least in part, a legal obligation. Anyway, so what do they say? They say, of course, and that's the marketing part, we have a responsible investment team which looks at the voting, and we bundle the voting for all our investment funds. So that's the first thing, which is, of course, interesting if those investment funds have another focus. I mean, I understand that I have a sustainable investment fund, and they probably would follow one of those 30% suggestions we've heard about the Netherlands. But if the investment fund is sort of hardcore profit-oriented, then probably not the same approach would be correct from the point of view of the investors. So, of course, bundling can't look at these. And I don't want to put too much emphasis on that point, because in most cases it will not matter a lot. But of course there may be cases where that makes a huge difference, and what, according to the fiduciary duties towards the investors, the management company should do. So they bundle voting. They don't care about those finer points of fiduciary duties. That's what was my takeaway from that. Now, there is the stewardship guidelines, and then there is the engagement report, and this is quite interesting. It said it does go very far. It discloses the individual voting on the website. So you can see each individual vote they cast on the website. So that's a lot of transparency, and that was the thing which surprised me, actually. I mean, it does make sense, but still, I found that surprising. So coming back to the point raised by Christoph before our lunch break, in approximately 7% they voted against the management proposal. which I do think is quite high. Especially if you think that many of the proposal management makes are completely boilerplate. I mean, you don't discuss normally about the dividend, for instance. I mean, you may do in single cases, but you don't do that typically. So I thought this was surprising, no? And then what they do in their report, they disclose not just their voting behavior, but also the second pillar of their stewardship policy, namely engagement examples. So they go much further and they send engagement letters to companies, and they enter, and that was also interesting, and I'll come back to that in a second, they enter into dialogue with Austrian enterprises. So that's what they do. Come back to that when we talk about barriers at a later stage. So first conclusion, or fifth conclusion actually already, there's definitely more transparency after Shareholder Rights Directive 2 as far as engagement is concerned. I cannot say whether there is more engagement, because obviously there hasn't been transparency. So whether Shareholder Rights Directive 2 actually fulfilled the aim, namely more engagement, we cannot tell. But at least we do have a starting point now. There's a suspicion it has, but I have no hard proof for that. So let us look then as a second step at some of the barriers typically named for the engagement policy of investment funds. The first one is cost. This is, I think, first one has to say that, and that brings me back to the structure of the market, there are comparatively few index tracker funds. Most of them are actively managed, and there's less cost pressure on actively managed funds, I think one can say, because they do not compete so much via cost as index trackers do. When I buy index trackers, I always look at the management fee and the percentage, and I wouldn't say that's the only thing I look at, but definitely it's a number, an important number. And you don't see that as closely. There's less transparency as well with actively managed funds, I think. And so there is less pressure, less immediate cost pressure. However, you see that if you look at Erste Management Policy again, when do they make use of their voting rights? They look at the size of their holding. They vote if the holding is more than 2 million euro or more than 5% of the voting rights. That's when they actually make use of their votes. With less, they do not care. And I think this is immediately done, goes with the cost argument, hand in hand, cost and impact. So they voted actually for 3.9 billion euro in 2020. And you see that in Austria, where it is an important vote. I mean, the investment is 1.9 billion euro, which is 2% of the Austrian market. That's something. And they voted in 34 Austrian companies, and the prime market in Vienna currently has 39 companies. And there's not much more than the prime market, to be honest. So that's almost 90% of votes. So I think a second issue, which one also sees from the report, is access to the companies. Of course, obviously, it is easier to focus on local companies, domestic champions. And that's what Erste does. It engages in its engagement policy, not in voting. In its engagement policy, it definitely focuses on the Austrian ones, such as OMV. That's the biggest Austrian oil company, which is an obvious target for any type of engagement policy. They are much more hesitant to engage with foreign companies, at least on their own. What they do try with foreign companies, and that brings us back to another point raised by Christoph, is that they go for collaborative engagement. So they try to influence those companies together. And one of the questions we've had from Jens and his paper was, are takeover rules on acting in concert a barrier to that? One might think so, because the Austrian rules on acting in concert are extremely strict. So once you start talking about board directors and directors' appointment, you're in trouble. It's not definite, but you're definitely in the orange zone, at least. No? So very strict, the Austrian one would be much more liberal in other jurisdictions. However, and this is also important for the disclosure of aggregate of major holdings, but in practice, and I can tell that as former chairman of the Austrian Takeover Commission, there's been no case where some type of ESG collaborative engagement has triggered the mandatory bid or even come close to it. It was just not discussed. If you look at the stewardship report of Erste, they don't talk about this. They don't mention the issue at all. I think the reasons are quite clear. I mean, if share ownership is concentrated, it doesn't matter whether you collaborate as institutional investors. You won't get the majority. Only a very few cases where this is even remotely possible. So that's the first point, and then, well, let's leave it at that. Now, the last one, proxy advisors. Are they important? Yes, definitely. They definitely are. Not for the Austrian ones, because Erste, not for the Austrian companies, Erste Assets Management says they can make use of proxy advisors, and if you look further and a bit more closely in the report, you will understand that they typically do so for casting votes abroad. So they don't use proxy advisors in Austria, where they say, with some such justification, we know the market better than ISS does, but they do, of course, use them at least for casting the vote, but I think also for not just, that means not just for the physical casting, but also for the recommendation on how to cast. So in Austria, there's not a huge role for the institutional investors, I think. This may not be true for all of them because there has been some discussion on the influence of proxy advisors in Austria as well. They've typically, proxy advisors do not have a huge influence if you just need the simple majority of the votes. They are too weak for that on the concentrated Austrian market. But if you need a supermajority, the issue is different. That is where the role comes in, and that is especially true, for instance, for a capital increase without the preferential rights, where you need at least a three-quarter majority. And there are some cases where such votes have been blocked by the institutionals, and the complaint was not that there are conflicts of interests. The complaints are that the international proxy advisors do not understand and do not care about the Austrian situation. Whether this is really true or whether this is just a reflective argument to protect itself is another issue. So I've taken much too long. Philip, please, the second part is yours.
So thank you. I will now come to the second part, which is called, according to our country report, portfolio governance. So portfolio governance, when we talk about portfolio governance, we ask whether the fund industry, whether a mutual fund is capable of influencing the company so that the investments, the sustainable investments, really get to the target, to the real economy. And let me first point out some general problems with the concept. So the first one is that mutual funds are very heterogeneous. So there is not the one type of fund you can see on the market. There are open funds, there are closed funds. They differentiate after their legal form or their investment style. So I think it's very hard to develop a concept which reaches all of the management companies. So we can see in some legal acts like the Shareholder Rights Directive, the directive operates with a very generic term like asset manager, and we can already see that it's causing some problems. What asset managers, so what kind of management companies fall into this term or belong to asset managers. So I think this is just a small sign that we have to be aware of what we talk about when we talk about asset managers, or what kind of funds we want to target and to get to bring their influence to a company level. So that's the first thing. Then the second thing is, well, this is not specific an Austrian issue, but yeah, there's literally no literature existent at the moment, so we have to develop and yeah, have to think about it ourselves, which is a nice thing. We have to be creative. But I think what's even more important is that we need, or we have to take into consideration the empirical research on the fund industry. So we want to know how funds behave in order to answer the questions whether they can influence their portfolio companies. So this is by no means a comprehensive research I did to the empirical studies or to the empirical research. So there are some indicators that ESG funds outperform their non-ESG funds. So as I said, this is not comprehensive or final, but if this would be true, if ESG is a superior investment strategy, then of course there is not so much a conflict with the beneficiaries' interests. If they get profit from investing or from following their ESG preferences, then it's easier, of course, for the directors of the management companies to use their influence to do what's best for their beneficiaries in a perfect world, at least. And the second point is, also we want to know, and we need to look at empirical research for that, we want to know what the incentives are for the directors of the management companies. And I just want to point out a recent paper I found in the financial literature, which point out an effect which is called a sustainability trap. So the idea is that if sustainable stocks are even overpriced, so the opposite from what I just said, that their performance is superior, but rather their stocks are overpriced with a sustainability agenda. And now the active fund managers try to pursue their beneficiaries' ESG preferences. And then they have these stocks, these overpriced stocks in their fund portfolio. And then this could lead, maybe, or maybe not, this could lead to overpriced fund structure, and which might lead to a proxy. So if you target their investment skills and on how much a fund is overpriced, then this could lead to an inferior benchmark. So the fund managers are considered to underperform compared to their other peers, and this might be a problem. This might lead to fund managers not pursuing ESG preferences, and so could weaken the whole portfolio governance agenda. This is a single paper. As I said, we just have to focus also on the empirical research in this area in order to address the regulatory problems. So, and then there are two big conflict relationships which also could be an obstacle for the portfolio governance concept. And the first one is so my eyesight is also really bad, I think. So no, but the first one is, of course, risk diversification. We all know that investment funds have to diversify the risk. That's an important principle of the whole investment fund law. And there are three stages according to the UCITS directive. And the first stage, which is not as important as the other two stages for the whole concept, but at the first, they only can choose from a set of eligible assets. So they cannot invest in anything that's on the market, but they have to choose between some financial assets. Of course, shares are one of them. So, and then on the second base, and here it starts, on the second base, they have to there is this quantitative risk diversification. So they only can invest to a certain percentage in the same issuer. And on the third stage, there is also diversification requirement. So this is a general principle which is not exactly defined in the directive, also not in Austrian regulatory law, for example, but it's also an underlying principle of the whole investment fund law. And that means that maybe if there's if the fund structure is too concentrated, then this might be a problem for the regulatory requirements. But as we found, currently there is no real indication that at least this third stage is a real problem. So it is allowed that a fund invests only in ESG stocks, for example, if it describes its investment policy accordingly. This is not news at all, but so this first principle of this third stage of risk diversification may not impose a risk to the whole portfolio governance strategy. So we think this might not be as big of an issue. So then there's the second possible conflict relationship, the compatibility of shareholder activism and mutual funds. So mutual funds are financial intermediaries. They try to get together as much as capital investments as they can to pursue their investment policy. And so on the second stage, I said that there's only a certain amount which one fund can invest in the shares of one issuer. So there are certain requirements. In Austria, it's 7.5% per shares, which is the upper limit for an investment in a single issuer. So a single fund can only acquire 7.5 shares of a company, of a portfolio company, which also naturally restricts or limits the possibility to influence the company. Of course, you can say 7.5% is a big stake in a company, but not necessarily in the Austrian market. In the Austrian market, with concentrated shareholder structures, the 7.5% might be of not much use in extreme cases, at least. Within these limits, again, it's not against the regulatory requirements, but it is rather encouraged for funds, for management companies, to develop an active voting strategy. They are obliged by regulatory law to do this. And so, again, within these limits of the quantitative risk diversification requirements of the UCITS directive, they can and they shall use their voting rights to influence the companies, and therefore can use their voting rights to pursue the ESG agenda on the portfolio company level. So, seventh conclusion, also again, this requirement, also the regulatory requirements aren't an obstacle, at least for some of the mutual funds that are registered in Austria. Thank you very much.